just own the S&P 500 and it will go up a ton. And in other words, we will always have that strong wind. I think that era is slowing down now and we're going to tack to a different type of environment. What if before the end of this podcast, we find out that Trump went to the microphones and said, I changed my mind. We're going to cancel every tariff that we've ever talked about, and there won't be any tariff talk anymore. I'm going to fire Elon, get rid of Doge. We're going to give an open-ended commitment to the Ukraine, whatever it takes and however long it takes. What would be the financial market response to such a move? I would argue
Jim Bianco, president and macro strategist at Bianco Research, has delivered sharp, independent insights on the global economy since 1990.
Known for challenging consensus thinking, he's built a decades-long reputation as a leading voice in finance.
Didn't the US just fail taking advantage of its privileged position, and only enriching the upper financial class? And now Trump sort of wants to cover up his failures by trying to put the blame on Europe and have them pay?
you're not wrong, but
If everything goes according to Trump's plan, what will the world, the US, Europe, other parts of the world look like once all is said and done?
I think what would happen if it does come down is two things. One, for Europe, I think it's a bigger deal for Europe than it is for the United States because...
Hey guys, welcome back to Less Noise, More Signal. Well, it's great to have you all back. It's great to have a really interesting guest today that I'm able to talk to. It's Jim Bianco. Hi, Jim. Cool to have you on.
Yeah, I'm looking forward to the conversation. Hopefully, I'm in Northern California and you're in Switzerland and this connection will hold.
Yes, yeah, we hope. You said something about Starlink, that is like Elon providing the bandwidth for our interview today, which is sort of nice, yeah.
Yeah, I'm on a Starlink connection here in California, so if we say anything disparaging about Elon, I'm sure he'll cut the connection off.
Okay, yeah, we won't talk about the magical money computer, I guess, or we'll see. Yeah, well, I mean, just for people who might not be familiar with you, for European folks, I guess, could you quickly introduce yourself? Like, who is Jim Bianco?
I am the president and founder of Bianco Research, affiliated with a brokerage firm called Arbor Research and Trading. We have been in the bond business, if you will, for basically since 1988. I spun myself off in 1990 as my own firm, Bianco Research. I do macro research with kind of a bent towards the bond market. I'll say this up front. I am very active on social media. You can find me at Bianco Research on YouTube and on X, Twitter, or at Jim Bianco on LinkedIn. We also manage an index which has an ETF that tracks it. It's called the Bianco Total Return Fund. If you're on Bloomberg, it's BTRINDX, or BiancoAdvisors.com is its website, and the ticker for the ETF is WTBN. So there, I got it all up front.
Nice. Yeah. Well, as for me, I didn't know about the ETF, so that's kind of good to know. That also means that on X you're not chilling your old products, so it's all good. Because I've never heard of that. So I've obviously known of you from X, and as you said, you're quite vocal and doing a lot of great posts. But I've never heard about the ETF, so definitely good to know.
Well, if you go to my X site, it is the pinned post at the top, and it's called what I learned in my year managing mon money, because it's about 18 months old right now.
Okay, I see. Yeah, great. Everything. We know about that now. That's great. Well, I want to congratulate you on popularizing this term. Mar-a-Lago Accord. I think like you sort of coined and popularized it, and now everyone has been talking about it. So congrats on that. That's also sort of what I wanted to talk about today, and on that sort of connection, I heard you say that Trump's policies are not tweaking around the edges, but looking to realign the world order in ways we haven't seen since World War II, so that's quite a statement. And so I was really, wondering, what are these monumental monetary and fiscal policy changes that Trump is really hoping to pull off here?
Okay, so two things. First of all, Mar-a-Lago Accord is, maybe I helped popularize it, but I didn't coin it. That is Stephen Mirren that coined it. He is the president of the Council of Economic Advisors for Donald Trump. He wrote a paper right after the election when he was an advisor at Hudson Bay Capital. And within the paper, he talked about the Mar-a-Lago Accord. The name is a riff on all of the big real financial currency realignments. We tend to name them after the resort or the hotel where they're made. So we're all familiar with Bretton Woods, the Bretton Woods Agreement. That's actually, to this day, is still a resort in New Hampshire where that was created. Or the Plaza Accord, which was the currency accord of 1985, which named after the Plaza Hotel. So there is no Mar-a-Lago Accord per se. It's a concept that we're doing something as big as Bretton Woods or as big as the Plaza Accord and calling it the Mar-a-Lago Accord and riffing off of those things. And of course, Trump owns the Mar-a-Lago hotels, so that's why it got that name. Now, I said, as you right, that this is as big as World War II. So let me start with a provocative question. Is the U.S. or was the U.S. going into the election either in a crisis or on the precipice of a crisis? Let me define it as too much debt, too big a deficit, too much government, too big a trade imbalance, that the financial system was being stressed too much. Well, in December, there's this guy named Jerome Powell. He runs this organization called the Federal Reserve. You may have heard of it. He gave a speech and said that the fiscal situation in the U.S. was unsustainable, and he said that it needed to change. Okay, I think that the starting point for the Trump administration and Stephen Mnuchin and Scott Bessent, the Treasury Secretary, and Howard Lutnick, the Commerce Secretary, is the status quo can't hold. We cannot keep doing what we've been doing. We have to change it. So in the process of changing it, they're trying to bring down the level of the dollar. They're trying to bring down the level of debt in the country to bring the country more in balance and help it grow a little bit faster. How are they going to do it? Two things. The first one is Bessent has been very clear that he says two things about the dollar, and I'll say what they are, and then I'll try and interpret it. He says, we are in favor of a strong dollar, and we are in favor of the dollar remaining its reserve currency status. But we are not in favor of other countries thinking that they can devalue their currency. So let me try and simply put what I think he's trying to say. The U.S. wants the dollar to continue to be the strongest monetary brand in the world and the reserve currency, but at the same time would like to see the value of it go down, not its status as a reserve currency or an important currency, just the value go down. And to that end, that's where tariffs are coming in. And Trump has been focusing those tariffs. You might ask the question, why did he start the tariffs with Mexico and Canada? Because they're our two biggest trading partners. Those are our biggest trade deficits are with those two countries. Number 3 is China, and he's kind of getting to China too. And I'll be honest, I don't understand the Canada part as much. There's some issues with Canada, especially around security. Basically, Trump's argument is that because of global warming, there's a new trade route that goes north of Canada, and there's a lot of Russian and Chinese warships that traffic that route. The Canadian Navy is not really equipped to patrol that route. So why does the U.S. have to spend a ton of money to do it? Well, just tell them that, Donald. Just say, go build some ships and deal with this problem. Instead of saying that we're gonna have to take over the whole country and make it the 51st state and all of that other stuff. Mexico, there is a bigger issue with that. We've got the flow of illegal migrants. We've got the flow of illegal drugs, and because of the free trade agreement we've had with Mexico, China's been taking advantage of that, where they send billions of dollars of goods to Mexico. Then they hire Mexicans to assemble it into a final product like a computer or a car, and then they ship it up north without a tariff. So China's been avoiding the tariffs that we put on them. I get that part why he's been hammering on them. So he's trying to imbalance that. Now, the other part that he's been doing is he's been looking at $36 trillion of debt and a $2 trillion deficit, and he's saying that is not only unsustainable. Let me throw in one other quick thing with it. In 2022, so 2 years, maybe almost 3 years ago, the U.S. started to have a larger interest payment than defense. So the economic historian Neil Ferguson wrote an essay in the Wall Street Journal a couple of weeks ago, quoting the 17th century economist Adam Ferguson, not relation, just same last name. And Adam Ferguson wrote 200 plus years ago that whenever a great power starts paying more in interest costs than their defense, they seek being a great power. And Neil Ferguson, went through the examples for the last 200 years, from the Dutch to the Spanish to the British, that whenever their debts got so big that it was more than their defense, they stopped being the dominant power of the era. Now, the exceptions were those countries that it got above it, but then they quickly brought it back down below it. Whenever you hear Elon Musk talk about Doge, why do we need to do this? The first thing he says, and he's done this multiple times, he says, we pay more in interest than in defense. We cannot continue to do this. So he's obviously, feeling off of that situation. So with that said, Trump is saying we have $36 trillion of debt. Where did most of this debt come from? The U.S. has been the policeman of the world, fighting communism, then fighting terrorism, now supporting Ukraine, Gaza, Israel and Gaza and everything else. A lot of that debt has been run up through security. So now he's effectively saying to the rest of the NATO allies and other allies, you have to start paying for it. Here's a bill for the security that we've been doing. And in that process, we're leaving us of our debt burden. So this is part of the bigger whole that they've been trying to push down. And that's that realignment that they've been referring to since the end of World War II. One last thought, just to kind of get it out of the way. Whenever some people hear about the Mar-a-Lago Accord, they talk about there's a debt swap idea in there, that Europe owns trillions of dollars of U.S. Treasury securities, swap them for a 100-year zero coupon bond. All you need to know about that is that's a payment mechanism. That's like you and me you agree to pay me money. So now we're going to argue whether you're going to send it to me by Venmo or you're going to mail me a paper check. That's all that is. It's just a payment mechanism. If you don't like that payment mechanism, there's other ways that they could pay. But the day we're recording, Germany lifted their debt brake so that they could continue, deficit spend to build up defense. All of Europe has been saying that they're willing to spend more money to spend on defense. So it appears that when Trump says, here's the bill for defense, Europe has said, fine, we're going to pay it. And we're going to pay it by building up our own defense. And in theory, that would mean that at some point when they start getting some traction, the U.S. could start spending less. And Europe could start shouldering the burden of being the policeman of the world from the United States. So that's kind of the overview of what it is and why it is so significant.
Yeah, that's great. Thanks. Yeah, for setting the stage here for everyone to be on the same page. I mean, I want to do some deep dives with some of the topics that you were talking about, but maybe sticking with the bird's eye perspective here for a moment. I mean, how successful has Trump been so far? What does he have to show for? I mean, in terms of tariffs, in terms of reshoring, because I think that's also something that's part of his plan to bring like manufacturing back, and then also in terms of the defense payments that you were alluding to. So just like objectively, for the first few weeks, months now that he's been doing this, what does he have to show for? So far.
Well,
this show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, New Hedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL.
I think the biggest one is the change of attitude in Europe about defense spending. That because he gave us a virtual speech to the World Economic Forum, in Davos 3 days after he was president, and said, "I'm going to demand that Europe spend 5% of GDP on defense." And we could quibble about whether or not it's going to be 5, but they've agreed that they're going to spend more. Now, you could say they were going to do that anyway, or you could say that they were predisposed to do that. And that's probably true, but they were a bit of a catalyst. So on that side, he's definitely getting some traction on defense thing. On the tariff side, he's getting traction in that he's getting more and more concessions out of Mexico right now. Mexico even announced about 10 days ago that they're willing to put 10% tariffs on Chinese goods that are coming into Mexico. So Mexico, like I said, China, we tariff Chinese goods like crazy coming in the United States. They ship them to Mexico as raw material, and then they assemble it as a car, as a computer, like I said, and then it just goes right up into the United States without a tariff. Mexico is now talking about that they'll tariff China in order to get Trump to get off their back. Mexico has said they'll put 10,000 troops on the U.S.-Mexican border to try and stop the flow of illegal drugs and try and stop the flow of illegal immigrants. So he's getting some traction at that point as well, too. And then finally, I'll say on the traction side, some big Wall Street important voices, Jamie Dimon, the president or the chairman of JP Morgan Bank, Lloyd Blankfein, the former chairman of Goldman Sachs, have all come out in the last week or so, and I'll paraphrase what they've said. They said, hey, don't dismiss what this guy's doing, meaning Trump. This might actually work, that he might actually bring down the value of the dollar, bring down the U.S. be more competitive, and maybe even lowering the deficit to GDP ratio and helping to bring things back into balance. And they were clear with that word might, that it might work. So they were saying I think what they were pushing back on people was saying to people that are saying, there's no way this is going to work. There's no way this is going to end but anything but badly. They're saying it might work. So he's seen some successes, and he's got some people saying, pay attention. There might be more coming down the pike. So we'll see how this goes.
Interesting. Very interesting. Well, one last high-level question, before we start to zero in. But if everything goes according to Trump's plan, what will the world, the US, Europe, other parts of the world look like once all is said and done,
I think what would happen if it does come down is two things. One, U.S. deficit would come down. The amount of government that is involved in the U.S. economy would come down. They may not go to balance. We're not going to pay off anything, but we're just going to bring down the deficit. The GDP will grow faster than the deficit, and that debt to GDP ratio will come down. The level of the dollar will come down, and some industries in the U.S. will become a little bit more competitive. All of that is going to be a net positive for the U.S. The net negative for the U.S. is that will also be somewhat inflationary. If you're going to bring down the value of the dollar and you're going to start making stuff here, and employing people to make it here, it will be more expensive. It will be more expensive. But the theory is, but now you've got more people employed and they're getting a paycheck and they will be able to afford more of these products. That's essentially what Lloyd Blankfein said just a couple of days ago. For Europe, it's actually, I think it's a bigger deal for Europe than it is for the United States, because when J.D. Vance, the vice president, went to the Munich Security Summit about a month ago and gave that speech, let me interpret what he was saying. Over the last 50 or 60 years, we, being the United States, have spent 5, 6, up to 9% of our GDP on defense, and we've defended the world. You, being Europe, you've spent 1, 2, 3% on defense. What did you do with that other 4, 5, or 6% that you could have been spending on defense if you were equal to us? National health care, green initiatives, more liberal progressive initiatives. so that our priorities have diverged. Well, if you're going to spend more in defense and you're going to have to start thinking like the cop of the world, our priorities will start to converge again. And if they do, we would present a more united front against people like Russia, China, Iran, North Korea. Because you hear a lot of people saying, well, don't push Europe, Donald, because if you push Europe to spend on defense, they'll just side with Russia. But I think if they did spend more on defense and did this, that idea that, they'll just give up and side with Russia would never cross anybody's mind then. So this is the potential positive outcome of this. Now, the last thing I'll say is, like I said, I'm in Northern California. I'm not that far away from Silicon Valley. And I like to say that in Silicon Valley is the land of 1,000 good ideas that never get executed, and you don't see this light of day. I might be presenting what Trump is doing as somewhat of a good idea or a necessary idea the status quo can't hold. But the other question that I can't answer, nobody else can answer is, okay, let's assume what he's doing is a good idea. Just assume it. Can he execute it? Can he actually make it into a good reality? We'll find out. And that's really the open question. And on that score, a lot of people are saying he's got Stephen Mirren, he's got Scott Besson, he's got Howard Lutnick, he's got Jason Furman, his National Economic Council advisors. These are people that are well respected, agree with his vision, and maybe they can make it happen, even though we know Trump is kind of a guy that's all over the place.
Mm-hmm. Okay, I see. Well, that's well said and well explained as well. I mean, from what I've been hearing, and also from what we've been hearing, as you said, when we listen to the news and everything, I mean, it seems like Europe is on the way of conceding, like they're sort of, okay, we're fine, we're going along with this plan. At the same time, there's also, from what I've been hearing, talking to friends and other people, obviously, a lot of people saying, well, the US is just flexing its muscles here, And so if I sort of take the European perspective for a moment, and I could say one could argue that the US as a whole has also handsomely profited from this position they have been in, or they are still currently in, and just throwing a few points at you, obviously issuing the world's global reserve currency, globalization, reduced production costs for US companies, lowering consumer prices, the outsourcing, also sort of increased corporate margins, for profit margins for corporates, keeping inflation in check, and low tax jurisdiction in Europe, where sort of profits are going to shareholders and not to the US society, some would argue. And maybe my last point, Europeans every year amounting to around 300 billions of euro, which goes to finance Americans in terms of like the retirement money, that goes into the US stock market. So sort of all of these points, the point that I'm trying to make here, and that's why I'm saying I'm siding with the Europeans for a moment, didn't the US just fail taking advantage of its privileged position, and only enriching the upper financial class? And now Trump sort of wants to cover up his failures by trying to put the blame on Europe and have them pay?
You're not wrong in that while the United States has had this privileged position, you're correct. European crowd screaming at us, for 70 years, you guys have been the cop of the world. You've told us what to do for 70 years, and we've just saluted and did whatever you did. And now you want us to pay for it on top of that. I get that. But you're right that whatever the case is, the United States took advantage of that privilege in a skewed way. And that skewed way has resulted in a society that is very much split between those that own assets and those that don't own assets. To give you an idea about the United States, bankrate.com is a website that does surveys on the banking industry. They put out a study every January. 55% of the American public say that in an emergency, their car breaks, medical emergency, take your pick, they can't come up with $1,000. They would either have to borrow it from a friend, a family member, or put it on a credit card. They rent, they don't own any assets. And then at the same time that came out, the Federal Reserve said that the top 10% of income in the United States is now 50% of all retail sales, and that's the most concentrated it's been in the top 10% at the same time. So we got this schism going on in the United States. A lot of that has come from globalization. By having globalization and having cheap goods, we have hollowed out a lot of manufacturing heavy industry in the middle of the country, literally in the middle of the country. And we have created, economic damage for them, and to the benefit of those that own assets, that have higher educations, that can get into more intellectual property type of businesses like finance and software development and technology and the like. You're right. But the reality is we've got this schism in the country. So here comes Donald Trump. Donald Trump says, I didn't create it. It's been created over 50 years. It's unfair. And those that have lost, he had 81 million votes. Those that have lost were the ones that voted him in. He agrees that they need to have the relief. He has got people with him that agree that they have the relief. And that's why the other thing internally within the United States that people are having a hard time is when he comes out and says, our focus is no longer the S&P 500, it's the 10-year yield. We believe that if our policies are correct, the 10-year yield will come down, signifying less inflation, signifying less debt being issued, a smaller deficit. All of those things will lower the 10-year yield and say we're on the right path. The S&P 500, it could go up, it could go down. And so those that have been benefiting from this program, and you see this on social media all the time, oh, he'll cave on this. He'll cave on this because the Fed and the Treasury and the president, they all want the U.S. stock market to go up. Their donors want the U.S. stock market to go up. He will cave on this. I don't think he will. I think he's focused more on the 10-year yield. And if the 10-year yield doesn't cooperate with him, that's a bigger concern for him than if the S&P corrects. So yes, to answer your question, you could argue, are you changing the rules of the game? Yeah, we are. We are changing the rules of the game. Donald Trump is changing the rules of the game. And the last thought for you, and I'll address this to Europeans. Will he cave on this? Will he go back on this? Two thoughts for you. First of all, if you look at his approval rating, I tweeted about this over the weekend about 3 or 4 days ago. You could say, look, he's got a 47% approval rating. And you could argue that's less than 50. He's not very popular. And that's one way to look at it. Another way to look at it is the average approval rating for a president since Obama's second term for the last 13 years has been 43%. And he's at 47. So for the last 13 years, again, I'm starting this at the end of Obama's second term, or beginning of Obama's second term, he's above average. So that's enough to say that at least for now, the American public is not souring on what Trump is doing. So if you want Trump to change this policy, you got to get the American public to dislike what he's doing. And so far, they're not disliking what he's doing. The second point I'll bring up about this is that provocative question I had a minute ago. Are we in a crisis? What if before the end of this podcast, we find out that Trump went to the microphones and said, I changed my mind. We're going to cancel every tariff that we've ever talked about, and there won't be any tariff talk anymore. I'm going to fire Elon, get rid of Doge. We're going to give an open-ended commitment to the Ukraine, whatever it takes and however long it takes. And those types of things. What would be the financial market response to such a move? I would argue the 10-year yield would collapse in price and yields would soar, because that's tantamount to arguing we are going to issue so many treasury securities that you're going to be drowning in them, and it would be taken very poorly. So my point is, you could be like the Economist magazine's cover last week, where they showed Trump with a can of gasoline and a lit dollar bill about to torch the world. And their story was effectively, Donald, just stop doing what you're doing. You're losing sight of reality. His argument would be, and go back and do what instead of this? I'm not going to go back to $2 trillion deficits on our way to $40 trillion of debt and just funding everything all the way across the board. We cannot go back to that. So if you want to tell Donald, you're doing this all wrong, You have to tell him what he should be doing, but you can't say, just go back to the way we were doing it a year ago. And so that's the other problem as far as will he continue to do this? They don't believe, and I would tend to agree with them, we can't revert back. We can't just call this off and say, let's just go back to the way we were doing things last year.
Yes, I see. Well, yeah, your second point is certainly great about the debt situation. I want to come back to this as well, but maybe addressing your first point real quick, because there's also, I want to rephrase my question in terms of like, how beneficial is this going to be also for the average American, because I'm just wondering, like, if we Europeans look at the average American, obviously we see, as we said, these, like, a lot of the lower tier people, they're heavy in debt, and they get another credit line all the time. But so far, it seems to have worked. And even from that sort of financialization in the US, like, one could argue the people on the lower end in the US have also sort of profited off this, And so my question would be, like, does it really make sense to bring back manufacturing, or hasn't the world moved on, to the US? And also, wouldn't that mean that the average American would have to, like, plainly or simply saying this, work harder again, because so far, they had a strong dollar and they can sort of consume their way out of it. And now, obviously, they would just have to work harder again. And I think, obviously, to your point, this makes sense, but will the average American put up with this?
Well, let's define the average American. Okay, so roughly speaking, US 330 million people, about 280 million or so, or 270 million of those are, above the age of 13. And something like 35 to 40% of the US has a college degree, meaning that, 60 to 65% do not. In this modern intellectual property world, you're very limited in what you can do without having high education, right? If somebody once said, if you can't write proper sentences or divide fractions, you're really going to be out in the outs from what job you can get. Historically, if you only have a high school degree and you never went to university, or you went partially to university, what are the jobs that you could have historically gotten in order to get a very good wage? Construction, manufacturing, heavy industry, and the like. Those are the people that are voted for Trump. Those are the people that are saying, we need opportunity. I'm sorry, I don't know how to code. I'm sorry, I don't understand the nuances of how, an ETF works, or I'm not good at negotiating and investment banking deals. I did not take a negotiating course at a top university in the United States. So those are the people that are saying, we want opportunities. And Trump has been there to offer, I'm going to try and get those for you and try and bring those back to the United States. Again, I would argue that it's a valid argument to say this ain't going to work. Okay, but then the flip side is, well, then what should he do? He's got the majority of the country that does not have advanced education. And that's not going to change. Not going to change anytime soon. There's no policy the government is going to do to get those people to go to college and get advanced degrees. And so where are the opportunities for them? That's why I think the Diamonds and the Blankfeins of the world are saying, I get it. I hear you. These people need opportunities. And if we could bring back some manufacturing and more construction jobs and more heavy industry jobs, that we can employ them more than we're employing them right now. So that's the schism that he's trying to fill. And that's who his base is. That's who put him into office. And that's what they expect. And he intends on trying to deliver on it. And that's why, like I said, he's not tweaking around the edges. He's trying to go right at this issue. He's trying to go right at this issue. And I would lastly say he's not condescending this group of people, because the problem is previous presidents have condescended them. Joe Biden said famously, learn to code. And that's almost an insult to somebody who, that doesn't know it. Barack Obama said, you can't wave a wand and bring these jobs back. In other words, saying to these people, you're screwed. stop complaining for opportunity. You're not going to get one. And so, but Trump has come to them and said, I am going to try and get you some opportunity. And like I said, maybe it doesn't work. Maybe it's a good idea and he can't execute it. This is what we're going to find out. And this is what I think is driving a lot of the volatility in the markets. I think the markets are starting to comprehend what he's trying to do. And they're comprehending that maybe it might work, maybe it won't work, but it is a high risk gamble. And that's what you're seeing in the gyrations in markets as we're trying to sort this out.
Yes, I see. Well, that's a great point. Like Trump being really on the side of the average American, so to say. And I mean, yeah, that's really what it feels like, even like judging from afar, like with friends I have in the States. And so like Trump did get that mandate and he got it not out of luck. It is really like something that's backing this up. And it's probably because a lot of people are feeling he's really on their side, and understands their problems. But I want to turn to this one contradiction I still see, in these US or Trump policies, and it's the one about the reserve currency status, like Trump wants to export fewer dollars to the world. That's what he sort of says, like outright or be in between the lines, But if not enough dollars are around, other countries will, by definition, sort of have to look for alternatives. And then I'm just questioning, like Trump wants to keep the dollar the world's reserve currency. So don't we have a sort of contradiction here at hand then?
We do if you look at it on a one-sided basis. Now, you're right. Let's remember how does the world conveyor belt, as I like to call it, work, right? The rest of the world makes stuff, they put that stuff on a boat and they send it to the US. Because we're the reserve currency, we pay for it with dollars. So then China, Mexico, Canada, those are our three biggest trading partners, are awash with all these dollars because we bought all these products from them with dollars. What do they do with those dollars? They reinvest them back in the United States, usually buying treasury bonds, maybe buying US securities or something like that, because those dollars don't do you very good in Beijing or in Shanghai. You can't walk down the street with a dollar and really buy a whole lot in those countries. You need their currency. So the argument is, if we lower the trade deficit by making more stuff in the United States, aren't we sending less dollars overseas and therefore less dollars to come back to the United States? True. If you look at it in that regard, true. But the other side of the equation that he is arguing is twofold. One, we're also going to bring down the deficit. We're going to bring down the need for overseas dollars in order to finance us. So while there'll be less of them coming, we'll need less of them. Again, whether that happens or not, that's what they're trying to do. And the second thing is, he's arguing, if we bring back more opportunity and there's more jobs and more paychecks in the United States, we can fund ourselves domestically because of these people now have more money and their savings rates, or with their savings vehicles, will be investing in these as opposed to foreign investment. Now, all that's great. And maybe all of that works. Maybe it all works. But it also isn't going to be seamless, right? You're not going to, for every dollar that we get less from foreign investment, we're going to create a dollar more of domestic investment, or for every dollar that we get less of foreign investment, we'll need a dollar less because we've brought down the deficit. It's not going to go one for one. It's going to go lumpy. And there's going to be excesses and shortages both ways along the way. That's why Trump, in his speech to the joint session of Congress, known as the State of the Union, although technically it wasn't, he said there's going to be an adjustment. That's political speech for, strap in, man. We'll get used to all these wild gyrations in markets because of that uncertainty as we try to go from where we were a year ago to the vision of where we're trying to go next.
Yeah, I see. That's also something, especially about bringing around the deficit, that I never thought about. But I mean, that's exactly the point that I want to turn to next, because sort of in many people's minds, this is also the elephant in the room, like sort of the question, can we really get down this debt level? Is that even realistic? And maybe let me quickly sketch out the argument that I usually hear. I mean, some people are saying, just like from a broad perspective, money in today's fiat system, so to say, is loan into existence. If there's less debt, then it also means that there's less credit expansion and maybe credit contraction. And then maybe also throwing in the argument that you usually hear, this meme by Lynn Alden, like nothing stops this train, debt will have to rise ever more, and sort of bringing down the debt level. yeah, it might be nice, but it will just be sort of a little drip onto a hot stone, and nothing will be solved after all. So maybe please explain to us, do you agree with this mechanism, and also do you agree with the sort of lowdown, or that is not going to happen, bringing down
Yeah.
the debt?
Well, I'll start off by remembering that the belief is, and I don't think this is wrong, we are starting from an unsustainable point, right? We cannot go back to $2 trillion deficits. Let's just run the $45 trillion worth of debt. Don't worry if we're spending ever more amounts of interest costs way above defense costs. And history says you stop being a great power if you wind up doing that. Just continue to do that. So we're starting from that point that we cannot continue that status quo, that we have to change. Yeah, go ahead.
Yeah, I mean, that's exactly one point that there's a whole lot of, there's a theory out there. Obviously, some people might be now rolling in their graves, but I mean, the MMT people, who have been arguing, well, it's not a problem, and that's reality today. And so maybe this assumption, why is it in your mind and in your sort of framework wrong? Why is it unsustainable? You said something about exactly, if interest payments for defense is higher, if interest expense is higher than the expense for defense and stuff like this, but maybe you can flesh this out. Why is it really unsustainable, and why can't we go on for another 30 years? Because obviously people have been calling out that is too high for a lot of years, I guess, and it's maybe the cake profit, so to say, the crash profits.
Right. I think it's a twofold issue. Reinhardt and Rogoff, two economists, wrote a book called This Time is Different about 10 years ago. And they looked at the history of debt in countries. And whenever your debt gets above about 95 to 100% of GDP, your economy starts to slow. US is 120. If you want the big example in the world right now, it's Japan. It's at 225. Now, why is it that your economy starts to slow? Because too much government spending is inefficient, bloated, and wasteful, and it tends to kind of slow down it slows down the mechanism of productivity and slows down the of GDP, of production. I meant production, not productivity. And that's why when you get to that high level, about 95%, it becomes a problem. The MMTers, their argument has always been, is the way I understand MMT. I've always argued it's a good description, but I have a problem with the prescription. And their description is that as long as you're borrowing and you don't have inflation, it's not a problem. Their argument, if I could simplify it, is they think interest rates should be at zero forever. And they think that tax rates in a country should look like the interest rate chart, going up and down all the time. And we have somebody like the Federal Reserve saying, whenever we have more inflation, we should raise taxes because that sucks production out, slows down demand, brings down inflation. With less inflation, we should lower taxes. Now, I get the argument, and that's why I said it's a good description of how things work, that maybe taxes might be more effective in stimulating or restraining an economy than interest rates. But in reality, no country is ever going to give bureaucrats that ability to tax them more and tax them less, like that. So that's what I mean by the prescription isn't going to work. So it's too much debt is really where the problem is. And the answer is, we've seen it in the US, we've seen it in Europe, we've seen it in Japan, with the strife that we've seen between what you guys would call the far right movements, what we would call the middle class movements, or the Republican movement, that they've been rejecting a lot of what we would refer to as the establishment movements, because the economy is bifurcating. Those that don't own a home, an asset, or have a portfolio fall further and further behind. And what really accelerated that schism was the inflation following the pandemic. When we went to 9%, Europe's numbers went, I think, as high as 11%. Wages did not keep up with that. So people that don't own assets, people that don't own portfolios, just saw that their standards of living shrunk. People that were at the upper end of categories probably saw the same thing too. I see wages, I'm a rich guy and I see prices going up 11% on inflation, but my paycheck went up 4. Yeah, but I own assets and I have excess savings. So I can weather that. I don't have to change my lifestyle. And so that's really why I think it's pushed through Europe and through the United States, this issue. I'll give you a final thought for it. 2024, there was an interesting year in elections because something like over half the population in the world voted for a new leader, and I've seen reports that that was the highest percentage that the public has ever voted for in history worldwide for new leaders. And the commonality throughout the world was who's in charge, kick them out. And it doesn't matter if it was the Tories in charge in the UK, which would be the conservative group, we kick them out for Labor, or the Democrats in charge in the US, which would be the liberal group, we kick them out for the conservative group, the Republicans. If you're in charge, you're out. And that we saw throughout the world. So we finally kind of hit this, inflection point where the belief is the status quo can't stand. And that's why publics are saying, who's in charge, get rid of them, because that is a vote for the status quo, and we don't want the status quo anymore. So I do think that we are at that point with this amount of debt that we can't continue anymore. And I think that the public is at that point too. Now, the last thought I would give you is you still might be screaming at me, you're wrong, you're wrong, you're wrong. It's not as bad as that. Trump believes it is. The Treasury Secretary believes it is. Commerce Secretary believes it is. 81 million people that voted for him believe it is. And his approval rating is holding up. He's not getting, to quote Lynn Alden again, he's not getting off this train. And he is going to continue to go forward with this policy right now.
Right. Yeah, exactly. That's good, because I wanted to quote her again as well, because I was interrupting you before, because I do understand this point, and let's assume Trump sort of is successful with this, but then he really stops this train and he brings U.S. government debt to a lower percentage, who sort of decreases it by a significant margin. Won't that bring on calamity, and maybe the metaphor here is that I hear sometimes it's like the drug addict, we've been on government debt for too long, and we got sort of drugged, and now the influence is gonna wane, and obviously it's gonna be hard, for a drug addict that doesn't have the drug anymore. So won't that equals calamity in markets and maybe also in the economy?
It doesn't have to. Because what Trump would argue is that there's more to this than just less debt. Now, let's be clear. When you listen closely to Bassett, what he's talking about is the target is debt to GDP. And I kind of alluded to this earlier. They don't want to pay down the debt to zero. They kind of say that for political purposes. But what they really think is more realistic is if U.S. nominal growth is around 5-6% that the U.S. economy is growing at. If we could get debt growth down to 4 or 5%, then debt to GDP starts to come down because the GDP is growing faster than the amount of debt. That's really what their goal is. That doesn't mean debt goes down. It means it just increases at a smaller rate, but it still increases. So it's not going to go away in that regard. Now, doesn't that hurt the economy? Doesn't that mean less government? Government in the United States is about 38% of GDP, which is one of the highest levels it's ever been outside of a war. It is the highest level outside of a major war, like World War II, World War I, or the Civil War. But and it's one of the highest levels even if you include war. Well, his other argument is we want to, hold the line. It's called the Trump tax cuts, but there isn't going to be a tax cut. What it is that if they don't approve the existing level of tax rates, they go back up. That's what the Trump bad tax cuts are. So there is no tax cut. It's just preventing a tax increase. And he's talking about deregulation. So he's also saying, look, we'll do with less government as part of the GDP mix, but we want to do with more private sector as part of the GDP mix, and maybe bringing down the dollar and bringing industries back. SoftBank has made announcements, and some others have made announcements that they're going to do this massive investment in the United States. Of course, SoftBank is famous for making massive announcements that they're going to do investment in the United States. And then that investment never, ever, ever really comes to fruition. So we'll see whether or not they do. But that's kind of the other side of the equation, too, is that if we get this deregulation and we get these holding the lower tax rates, that we'll get more private sector GDP to offset the reduction of government GDP. And again, I'll remind you about that timing thing. Maybe the government numbers come down faster than the private sector numbers go up. They're not going to be one for one. It's going to be a little bit lumpy and a little bit uneven, and that's more of an adjustment process as we go through from here.
Yes, I see. Okay. Yeah, it would certainly be interesting to see if the private sector really will be able to take up the baton here. But I mean, it's yet to be seen. But I want to maybe zoom out real quick again before I want to finish up with sort of the how investors also need to position in all of this, But maybe zooming out, just because one last argument that I'm hearing a lot is that people say Trump is really playing with fire here currently, and the entire world, because obviously we are not in a free market world with free trade only, but the more Trump's policies drive a potential wedge between former allies and just other sort of nations, the less interconnected the world is going to be, the less globalization there will be, and in the end we end up poorer altogether. And so is that a risk that sort of potentially here?
It's a big risk. As a matter of fact, there's a new word, at least new to me, that deglobalization is now giving way to the term segmentation. So you've got globalization, and now we might have segmentation. And so we are heading down that path, and that is a risk. But, and if you want to say he's playing with fire, you might not be wrong. But I will come back to what's the alternative? What should he be doing instead? And like I said, if your answer is go back to $7 trillion budgets and $2 trillion deficits and get the debt to $40 trillion and don't worry about a $2 trillion trade deficit and tell the middle class that's waiting for a manufacturing job, it ain't going to happen. That's not the alternative. So what should he be doing? And so it really comes down to, I think, a lot of the pushback, the Economist magazine pushback and stuff like that, is this idea that, no, it's not a crisis. You don't need to, blow up the whole system right now. It wasn't at that precipice point right now. Of course, the flip side of that, if it wasn't at the precipice point, then don't tell me that we need to tax the rich and do all this other stuff, because then if we're not in a crisis, we don't need to do that either. So that really is the real crux to the question. And again, Trump believes we are at the precipice of a crisis and trying to prevent it. So does Bessent, so does Letnick, Commerce, Treasury, so do his 81 million people that voted for him. They believe it. So even if you want to credibly tell me we're not at a crisis, and I agree with you, fine, they're still doing this anyway. And this is what we have to understand when it comes to the next thing we're going to talk about investments and stuff.
Yeah, exactly. That's what I want to turn to next now in terms of like, what's your short to midterm outlook for markets then? If we like sort of now try to put all these thoughts into practice here.
Well, the short-term outlook, I'll give you all three real quick. The short-term outlook is we're going to continue to get a lot more volatility because we're still uncertain about whether or not these policies are going to be effective, and if they are effective, how are they going to be effective? But the medium to long term, I've been using the term the 4, 5, 6 markets. I've been arguing that over the next several years, cash will return, at least U.S. cash, will return 4%. Money market funds will average at 4%. Bonds, the average coupon in the bond market, if you add in mortgages and you add in corporate bonds and everything, is about 5%. Bonds will return you about 5%. If you look at stocks, given the high valuations we started the year at and the history of very high valuations with low returns, I think at the index level, stocks are going to return you 6. So 4, 5, 6. So gone are the days, now you could have individual years that do this, but over the long, medium to longer term, of expect 10, 12, 20% out of stocks, because that's what they've done. They've been up 25% the previous 2 years. So expect more of that as we go forward. So I think if we go into these lower return periods, it changes the investment mix and it changes the outlook for where people are going to go. Now, I'll throw out one other quick thing. What is driving a lot of this is my belief that structurally we're going to have higher inflation, and we're going to continue to have higher inflation. When I say higher inflation, the Federal Reserve wants us to believe that they're going to get inflation to under 2%, and it's going to stay under 2%. We've been at, by the way, 46 straight months with core CPI, 46 straight months above 3. So they can't even get it under 3, let alone under 2. I think that the inflation rate is going to average around 3 or 4%. If it's going to average around 3 or 4%, just to give you one metric, the Fed has this tool called R star, right? And that is the neutral funds rate. 3%, if you have 3% inflation, they say that the funds rate should average about 1% above the long run inflation rate. Well, if we got 3% inflation, one level above that is 4, and that's the 4 in money markets as well. And then finally about inflation, 2 other quick things. Look at Japan. Japan, for the first time, maybe in our lifetime, has more inflation than the United States. And their real rate bonds are telling you that they're even going to get even more inflation on top of that. And that's why you're seeing the Japanese 10-year yield is soaring to the highest level since 2008 at 1.5%. Now, you might argue 1.5% doesn't sound like a lot, but it was under 50 basis points just at the beginning of 24. So it's tripled in its level in terms of interest rates. Look at Europe. I've been one that's argued that all of this defense spending that they're claiming is going to be very inflationary for Europe. And one of the problems Europe has, if I could turn it around about the European defense spending, is there's no agreement as to what this means. If you listen to Poland, who's got a border with Russia, Poland has said we want 500,000 troops armed and ready to go, and we'd like the French to help us put nukes in Poland to keep the Russians away from us. Then you go to the Spanish. Oh, and they literally said a couple of days ago in the FT, quoting the head of Spain's government, hey, we're 1,000 miles away from the border. We don't have to worry about putting troops on the border stuff. We're going to worry about cybersecurity and green initiatives. So we're going to greenwash this whole thing. And cyber initiatives to me sounds like more canceling people that say things you don't want to say, you don't want to hear on social media. So they've got a completely different set. They both agree we need to spend on defense. But the Spanish definition of spending on defense and the Polish definition of spending on defense could not be more different. And then all the way in between, you've got everybody else. I think all of this is just massive government spending, which just means more inflation is coming to the continent of Europe. And look at what their interest rates are doing. They're going straight up right now on this idea of more debt and potentially very stimulative and potentially higher nominal growth through some more inflation. So that's why I think that 4, 5, and 6, 4 because the funds rate can't get below it, 5 because interest rates are going to stay sticky, and that's going to take a toll on the stock market. Not destroy it, but the stock market's not going to return you a whole lot more than the options of cash or the bond market.
Mm-hmm. Wow. Well, some very interesting takes here as well. I mean, one thing that you got me curious on, and maybe it's somewhat related, but in terms of inflation, like if given you are expecting higher inflation, like structurally, so to say, do you think, or how likely is it that at some point we will see the Fed maybe increasing and adjusting its inflation target to 3%, like some people have been calling for? And I mean, that could be, just a huge change, or wouldn't it be sort of?
They won't do it officially. Now, the Fed has every 5 years, they have a framework review, and that is this year. The last one was 2020, and they're having another one this year. By the way, communist governments and the Federal Reserve have 5-year reviews. So it's the only 2 organizations that ever do that. And they have said that during this 5-year review, what is not on the table is changing the target from 2%. Now, that might be the official target, but the question is whether or not they have an unofficial target. But part of the problem is that the Fed boxed themselves in. In May of 2022, when the inflation rate was 8.6%, Jay Powell had his one and only public meeting with President Biden in the Oval Office with Janet Yellen, the Treasury Secretary there. And I'm not exaggerating. I'm just kind of paraphrasing, but it's not that far from what he actually said. When President Biden pointed at Jay Powell and said, America, that's the guy that's going to get inflation to go away. And ever since that meeting, he has started every press conference. We're recording the day before the next press conference. He starts every press conference. The first sentence, nobody pays attention to because it's the same one every time. We're strongly committed to the American public and our goal of getting inflation under 2%. You say that 8 times a year at all 8 press conferences for 3 straight years, 24 consecutive times. Now, how are you going to come out and tell us, okay, forget it now. We're not committed to 2%. We're going to change it to 3. So they're kind of politically boxed into this 2% target. But that doesn't mean that they can't have like an unofficial target of somewhere around 3.
Mm-hmm. Okay, I see. Yeah, that's an interesting thought. Well, I mean, another thing I want to get your take on is really, when it pertains to portfolio construction, because I've been hearing some people, obviously for the past 3 years, we heard people say the 60-40 portfolio is dead, and now I've been hearing some people saying maybe Trump with his policies is bringing back or reestablishing the 60-40 portfolio, making it great again, so to say, by bringing back negative correlation between stocks and bonds. Is this something that you're seeing as well, or is it too early to tell, or what are your thoughts there?
It's a little more nuanced. So I kind of agree with both statements, and I'll tell you why. I think that the old 60-40 portfolio is dead, and it's been dead for years. Now, what was the old 60-40 portfolio? This is the pre-pandemic 60-40. That was stocks always go up. They always go up 10 or 12% a year. You have to be in stocks. Bonds, Tina, there is no alternative. You have to be in stocks. And so everybody into stocks. Well, what do we use bonds for? The 40% in that environment was crash insurance, was the old risk-off rally. That whenever the stock market wobbled, the bond market would rally and it would offset the losses in the stock market. That was the old 60-40. That not only hasn't been working, but it famously blew up in 2022. The stock market fell 25%, and the bond market lost you more money than the stock market. And you just got crushed both ways. And I would even argue in the last month that hasn't been working. The yield on the 10-year treasury as we talk right now is 4.29. Where was the yield on the 10-year treasury on February 25th when the stock market was 1.5% off of its all-time high? 4.29. So if you ran into bonds saying, well, the stock market's toast and it's going to fall a lot. Okay, it did. Bonds didn't rally at all because that environment is no longer the case. That negative correlation, I think, is history. Now, where does that mean for bonds in a portfolio? 4, 5, 6. If the argument is that the stock market's only going to give you a 6% return, valuations were too high, and the like, then a 5% return out of bonds is a competitive investment. It gives you most of what the stock market would offer you with less volatility. Look at the bond market last year, 2024, the Bloomberg U.S. Aggregate Index, the biggest measure in the U.S. It had a bad year. It was up 1.5%. That's a bad year in the bond market now, up 1.5%. Bad year in stocks is not going to be up 1.5%. It's going to be a lot worse than that. So for a lot of people that have more conservative risk profiles, I could get 80% of what the stock market will offer us over the next several years with 40% of the risk. That sounds like an enticing environment for them. I don't need to chase and FOMO in fear of missing out in the stocks. Tina, there is no alternative because that era of 20% gains and soaring stocks might be behind us. That doesn't mean the stock market is a disaster. It just means that, we're going to go sideways. I've been using this metaphor that it's in sailing. I am not a sailor. I know nothing about sailing. But if the stock market is going up 25% a year, it's like I'm in a sailboat with a 25-knot wind. All I got to do is get the damn sail up in the air and the boat's moving forward. Don't need to be an expert salesman in a 20-knot wind. Just get that sail up and you go forward. Just buy the index and you're going to make money. What if it's only a 5-knot wind or a 6-knot wind? Now I need to tack and trim, and I need to be a little bit more nimble, and maybe I don't know how to do that. That's the stock market environment I think we're in. I think that people need to stop asking the question, should I buy the market? Is the market going to go up? Meaning the S&P 500 or the Euro Stock 600 or something like that, and ask, maybe the better question to ask is now a good time for financials? Should I avoid healthcare? What do you think of energy? Going back to those kind of questions that we've never had to ask, because when the stock market's going up 20% a year, who cares about any of that other stuff? Just own the index and go. But now we need to start to figure out how to do those other things. And that's why I think that overall, the market will return you 6%. But there'll be opportunities that'll be much better than that, and there'll be opportunities that'll be much worse than that. But bonds will fit in there because they'll just give you less of the stock market with less volatility. And that is what a lot of people really want. I'll take most of the stock market's gains without the risk of a horrific loss. I don't need to speculate anymore in stocks. So we'll see if that turns out to be true, but that's the premise I'm operating under.
Okay. Yes, I see. Well, great. Just great, James. So I just saw we're coming up on the hour here, so I want to be conscious of your time. But maybe just to finish off, two more questions wrapped in one, sort of like, just to summarize, you explained it already, but where do investors put their capital now, concretely speaking? And maybe some of my listeners will also be interested in knowing about, what about risk assets like Bitcoin and crypto, like the true risk assets, so to say. What role will they play going forward?
So I would basically say to the first part of the question, you got to temper your expectations. As primarily a macro guy with a bond bent, I think a lot of people, come to me and say, okay, there's some big multi-trillion-dollar asset class that's going to go up 20 or 30% this year. Which one is it? Because there's always one that does. And I'd like to say, well, maybe now we're in that environment where there isn't one that does. Now, I'm not saying they're going to go down. I'm just going to say that there isn't. Go buy this ETF that has 18,000 securities in it. Watch it go up 20%. Kind of like the stock market or something like that, that we might not be in that type of environment. We might be in more of a discriminating type of environment where, like I said, maybe you want to be in energy, maybe you want to be avoiding healthcare, or vice versa, or something like that. So we need to change our approach in that environment. And this is going to be the hardest thing for people to basically, because whenever I say that to some people, no, people say that all the time. And it never works out that way. Just own the S&P 500 and it will go up a ton. And, in other words, we will always have that strong wind. Just get that sail up there and you don't need to know how to sail and you'll just keep moving forward. I think that era is slowing down now and we're going to tack to a different type of environment. Now, what about risk assets? I would actually argue to you that's the way to look at it. I would argue that if I was constructing a portfolio, that I would have a lot of it, maybe 50, 60% of it in cash and bonds. And that, so good. I got now this base that's going to churn me out 4.5, maybe closer to 5% in the market. What about the other 40%? I'm going to bypass the broad indices. And I'm not going to buy the S&P 500 or the Nasdaq. I'm going to look at the possibility of playing sectors or themes or even individual stocks. Well, I don't know how to do that. That's too much work for me. I've never had to do that. So let me offer this final thought for you on that. And by the way, in those sectors and themes and stuff, Bitcoin falls in there, gold falls in there, and the like. One of the biggest growth rates in the ETF business in the United States has been active managed ETFs. They're booming in the bond market. My ETF, WTBN, is an actively managed ETF. In the stock market, maybe Cathie Wood was one of the early, more popularized, actively managed ETFs. There's more of them coming. So maybe what we're going to see in the future is people are going to say, do I buy the broad index? Or they're going to say, John Doe or Jane Smith is the manager of the XYZ fund. Do you think it's worth me giving money to them to see if they can outperform? It's kind of like the way we did it in the 90s, right? We were all talking about star managers and giving our money to star mutual fund managers. Well, now those star managers might be running ETFs. Very final thought for you very quickly. History shows that about 85% of equity managers cannot beat their index. And you go, well, why would I want to give it to active managers if they can't beat it? Because why they can't beat it again is that strong beta wind of 20% gains. When the returns go down 5-6% over a period of time, the amount of active managers that can outperform goes up. In bonds, historically, regardless of the environment, about 45 to 50% of actively managed bond funds can beat the index. The index is much easier to beat in bond funds. So if you're thinking 5% in bonds, active managers, if you just picked one randomly, you've got like a 50-50 chance that they'll do better than that anyway. And so active management in bonds can work because of the structure of the bond market, that it's easier to beat the index. Or as I like to say, I'll give you a sports analogy. Equities is like playing equities is like playing golf. You want to break par, you want to beat the course, you want to beat the benchmark. Bond management is like playing tennis. Forget about, there is no benchmark. You just want to beat the other opponent. You want to be better than the other bond manager. And so that's kind of the big difference between the two. So look towards, I think we're going to be rotating into an environment of active management. And yes, those active managers, what's happening now is, I just had a meeting with one yesterday. More and more active managers are going to bring up ETFs. And you can buy them just as easily as you can buy anything else in your brokerage account and invest with them that way. So that's going to be the big change if these returns slow down, because as we look for alternate environments or better returns, yeah, you may not know much about, whether or not energy will outperform financials, do better than healthcare or consumer discretionary, but there might be a ticker symbol that's an active manager to let them do it for you.
Wow, yeah, that's actually great advice, Jim. I mean, if I want to go down this active bond management route, my last question is, any high signal person that you could point us to that we should bring on the show just to do a deep dive there?
Well, as far as on the active management point, and that's what we do. But there's a number of people that are starting to bring them up. I like Rick Reeder, BlackRock. I think he's been doing a great job. He's got a couple of actively managed funds. Vanguard's brought up 3 funds. Dan Iverson at PIMCO he's got a couple of funds. Rick Harper at Wisdom Tree, he might be another, or Kevin Flanagan at Wisdom Tree. They might be some interesting people to talk to about the bond market as well. They've got some actively managed funds, and in full disclosure, Wisdom Tree is also my partner with the WT and WTBN is Wisdom Tree in the ETF that tracks our index. So there is a lot of people that are starting to come to the fore in terms of actively managed bonds. Now, I'll emphasize something about actively managed bonds. We started our fund. I'm just using myself as an example. We started our fund in December of 23. We started talking about our fund in 22. And I said, look, the Fed's raising rates. We're going to go from 0 to some higher level. Well, we found out we went from 0 to 5.5% on the funds rate. That period from 2020 to 2023 was one of the worst periods ever to be a bond investor, ever, because you lost equity type investment losses in bond. Well, we waited to the end of 23 because I said I wanted to wait till that horrible period of readjustment was over and then start an actively managed bond fund in December of 23. So what I would argue to you is when you look at actively managed bond funds and you look at the 3, 5, 10-year record, you go, holy cow, look at that. Yeah, because that's that 20 to 23 period. Well, we're no longer a zero interest rate world anymore, or negative in the case of Europe. We're now 5% interest rate world or 4% interest rate world. That's a very, very different world right now. And that's why I think active will start to work now. Active was nothing but tears in 20 to 23. That's why I didn't start my fund 2 years earlier. I was waiting for that horrible period to end. And that's why I think from moving forward from here, it will be so if you like the idea of 5% on bonds, you can maybe get 5.5 or 6 from an active manager. And so there is a role for bonds as a lower beta, lower risk alternative to the stock market.
Mm-hmm. Yeah, definitely something I want to explore, because sort of as a young person like me, everyone is telling me, yeah, but bonds, go away, drop them. It's not interesting. But obviously you're telling me now yeah, there's also a rabbit hole that one needs to explore. And so that's definitely really interesting.
Well,
Something I want to do.
the reason people tell you that is because bonds, what they do is they offer you stable income, they offer you lower returns, but they don't offer you horrific losses. That is a very good investment for endowments, for some pension plans, for some older people, for people that have less risk. For people that have longer tail time horizons, I'm going to own this for 30 years and I have the ability to take more risk. I understand why they don't fit for their portfolio, but that higher risk investments like Bitcoin might make sense for you. But an investment like Bitcoin may make zero sense for a very old conservative investment with a short time horizon. So it all depends on where you want to fit that into the equation right now. And so there is a role for them there. Yeah. So like I said, for all the young people that tell me don't do anything with bonds, they're worthless, they're not going to make you any kind of money. I understand that. But then I'll go talk to a bunch of 70-year-olds and say, I can't invest in Bitcoin. What if it falls 50%? I don't have another 50 years to live. I can't wait for another winter to go through before they start to go back up. It makes zero sense for them to invest in it as well. Bonds, just churn me out that 5%. Thank you very much. And I'll be very happy. So it depends on where you are in that risk spectrum as to whether or not one of those investments fits.
Yeah, exactly. It depends on sort of the lifespan that you have and sort of, yeah, how many years you have, but also maybe what the size of your portfolio is, because I know a lot of, especially Bitcoin and crypto people who made a lot of money. And now they might be a little bit inclined to take some of that off the table, some of the chips, and then where do they go? And as I can see, they end up investing some of that in bonds as well, even though they are Bitcoiners by heart. So that's something that's also interesting to see. But well, I don't want to take up more of your time, Jim. Thanks a lot for doing this. That was great. I learned a lot, and I guess the audience will have learned a lot too. So yeah, maybe we can do this in the future again and maybe talk a little bit more about Bitcoin and crypto and get your perspective. But for the time being, we'll leave it at that. Thank you. Thanks a lot.
Thank you. Enjoyed the conversation.
Bye.